Palantir just surged 21% in 4 days. Now the AI committee has a verdict, and it's not the one you might expect. Quick disclaimer first, this is AI-generated research for education, not financial advice. Do your own due diligence. Now let's meet the committee. 7 specialists ran the analysis. Technicals, sentiment, news, fundamentals, a bull versus bear referee, a trader, and a portfolio manager who makes the final call. First, the chart. Over 4 trading days from May 27th to June 1st, Palantir exploded 21.2% from 132.51 to 160.65. The trigger was exceptional volume, 92 million shares on May 29th alone, the highest in the dataset. Longer term, PLTR broke out of a 16-day consolidation range and now sits 13% above its 50-day average at $141.89. But here's the critical level. The 200-day moving average at 161.67, just above the current price, is the wall it still needs to clear. Momentum indicators are a split read. MACD has crossed positive at plus 2.09, a textbook bullish reversal from minus 2.81 just weeks ago, but RSI has rocketed to 69.96, touching the overbought threshold. And price is already 4.3% above the Bollinger Upper Band. Extended, but breaking out. The technical analyst's verdict, this is a valid breakout from a classic consolidation pattern, but price has run ahead of near-term support. The short-term call is cautious. If PLTR closes and holds above 161.67, the long-term trend reverses. If it fails, expect a pullback to $150 to $156. Now, sentiment. The overall read, bullish, 7.2 out of 10 with high confidence. The dominant narrative is an AI software recovery after a brutal 6-month SaaS sell-off. And Palantir is right at the center of that story. On stock twits, 30% of messages were explicitly bullish, 13% bearish, a 2.3 to 1 bull-to-bear ratio. Retail conviction is energized by recent catalysts. One long-term holder described riding the stock from $18 to $150, with diamond hands through all the FUD. On Reddit, the theme is software rotation, money flowing out of hardware and into platforms like Palantir. The big sentiment shift? Jensen Huang's statement at Computex, quote, "Agentic AI is coming, and it's going to require more software, not less." That dismissed the so-called SaaS-apocalypse fears that had crushed software multiples for 6 months. For Palantir, whose Foundry platform is a backbone for enterprise AI, the market heard a direct endorsement. The news analyst flagged 3 concrete catalysts. First, and most impactful, Thomas Cavanagh. Construction extended its Palantir Foundry partnership through 2035. And is now commercializing Foundry tools as a channel partner across the entire construction industry. That single announcement triggered a 17.4% single-day spike, and it signals Palantir has cracked a scalable indirect sales model. Catalyst 2, Ottawa tripled Palantir's Canadian military contract to $46.8 million, a 300% expansion in government revenue from Canada alone. Catalyst 3, Rackspace signed a memorandum of understanding naming Palantir as the AI software layer for regulated enterprise cloud workloads alongside AMD. Note, it's an MOU, not a signed revenue contract. Macro tailwinds are real. US tech is up 28% year-on-year. Enterprise AI budgets are expanding, and the Pentagon's $9.7 billion Microsoft contract validates continued government digital spending. Year to date, PLTR is still down 6.7%, meaning this week's rally is a recovery, not a new all-time high chase. Now the numbers, and they are genuinely exceptional. Palantir's trailing revenue is $5.22 billion. In Q1 2026, revenue hit $1.63 billion, up 84.5% year-on-year. That's the growth rate of a startup inside a company worth $385 billion. The quarterly revenue trend is a straight line up, from $884 million in Q1 2025 to $1,004 in Q2, $1,180 in Q3, $1,470 in Q4, and $1,133 in Q1 2026. 5 consecutive quarters of double-digit sequential growth, averaging 16.6% per quarter. The margin story is even more striking. Gross margin is 84.1%, rare even for SaaS. Operating margin has expanded from 19.9% in Q1 2025 to 46.2% in Q1 2026, more than doubling in 1 year. Net margin, 43.7%. EPS grew 325% year-on-year. Free cash flow is the gold standard, and PLTR prints it at scale. Q1 2026 free cash flow was $891.8 million on $1.63 billion revenue, a 54.6% FCF margin. Annual FCF run rate $357 billion. For a software company, this is best in class. The balance sheet is a fortress. $8.03 billion in liquid assets. Cash plus short-term investments, against only $210 million in total debt. Current ratio of 6.91 times. Stockholders' equity up 55.7% year-on-year to $8.45 billion. This company does not need external capital. The catch: valuation. PE on trailing earnings is 182 times. Forward PE is 77 times. That's not a typo. The gap exists because Q1 2026 was the first fully profitable quarter. The market is pricing in growth moderating from 84% this year to roughly 40 to 50% over the next 2 years. If PLTR beats that trajectory, there's upside. If it misses, multiple compression is severe. The bull's strongest argument: PLTR has achieved something rare. 84% revenue growth with 44% net margins simultaneously. The fortress balance sheet eliminates existential risk. The Cavanagh channel model could dramatically expand the total addressable market. And the forward PE of 77 times already prices in deceleration. This is not a naive valuation. The bear fires back. QOQ growth already decelerated from 19% in Q4 to 16% in Q1, the first crack in the acceleration story. Stock-based compensation is 35% of net income. Oracle just won a $9.7 billion Pentagon contract. And if $8 billion of cash is sitting idle instead of being deployed, what does that say about growth opportunities? The research manager's ruling: overweight, not buy. The bull case is valid for the next 12 to 18 months, but buying into a 21% 4-day rip with RSI at 70, above the Bollinger Band and still below the 200-day average, that's chasing. Staged entry beats full commitment here. The trader's phased entry plan. Phase 1. Buy 0.75 to 1% of portfolio now at 160 to 162s. Eliminate the regret of missing a breakout. Phase 2. Add another 0.75 to 1% on a pullback to 155 to 158, or on a confirmed break above 165 on 80 million plus volume. Phase 3. An optional final add if the thesis is definitively validated after Q2 earnings. Hard stop, $140, below the 50-day moving average. If that breaks on a close, exit everything. That's a full technical thesis failure. On the upside, trim 20 to 25% at $170, another 25% at $180 to $185, and let the final tranche ride with a trailing stop above $190. Portfolio manager's final decision: overweight. Conviction 7 out of 10. The 12 to 18 month thesis is high confidence, 8 out of 10. The valuation sustainability beyond 18 months gets a 5. This is a high-quality growth business priced for flawless execution. 3 scenarios. Bull case, 40% probability. Growth sustains at 50 to 60% through 2026. Margins hold. Stock reaches $200 to $220. Base case, 45% probability. Growth moderates to 40 to 45%. Stock consolidates at 165 to 180. Bear case, 15% probability, growth falls below 35%, multiple compresses, stock drops to $120 to $130. Watch these 4 metrics every quarter. Revenue? QOQ growth must stay above 15%. Net margins must hold at 45% or better. Deferred revenue growth should track revenue growth, and free cash flow conversion must stay above 30% of net income. Any miss on these is your signal to trim or exit. That's the AI Investment Committee's full walkthrough on Palantir. Exceptional fundamentals, real catalysts, a valid bull thesis, but current entry is extended after a 21% run. Overweight with discipline. As always, this is AI-generated analysis for education only. Do your own research before making any investment decisions. Thanks for watching.